Hello and welcome to part 1 of Accounting for Stockholders' Equity. Watching this video is going to help prepare you for class. It's important that you view this before class so we can learn more together in class. This video will walk you through an overview of stockholders' equity. After viewing this video, you will be able to state the 5 different owner's equity accounts. You will understand what each account reported on the financial statements represents. The owner's equity section of the balance sheet reports 5 things. Preferred and common stock represents shares of ownership sold to outside investors. Stock is reported on the balance sheet at par value. Additional paid-in capital represents cash received from investors that is greater than par. Treasury stock is common stock owned by the company. Retained earnings represents the profits and losses less dividends since the company began business, and a few other adjustments we will learn about in this class. Other comprehensive income represents gains and losses that have not yet been reported on the income statement. OCI gains and losses are generally related to foreign currency, pension accounting, and available for sale securities. Stock is reported at par value. Par value is the amount per share that a shareholder is responsible for paying if the company goes bankrupt. Par value is set by the company in the Articles of Incorporation. Par value is normally very small since it determines the liability of shareholders. It is common to see a par value of 1 penny or less per share. Fair market value has no relation to par value. The company sells ownership at the current fair market value. Stock is always reported at par value, and paid-in capital is the difference between cash received from owners and par value. It takes both accounts to record the total received from shareholders. Take a moment to look at the example that shows common stock reported at par value and paid-in capital for the difference in cash received and the par value. Preferred stock is a type of ownership. Investors purchase preferred stock for the right to receive a stated dividend. An investment in preferred stock is made to receive income. Preferred shareholders have no voting rights. Preferred stock has a percent associated with it that determines the expected dividend. The total cash expected to be received is equal to total par times the stated percent. Preferred dividends must be approved by the board of directors before they are declared. Dividends are not an automatic obligation of the company. Preferred stock may have a callable feature or a convertible feature. Callable means the company can buy it back from the investor at a set price after a specific time has passed. Convertible means the preferred stock can be exchanged for common stock. This allows an investor to participate in the appreciation of common stock. The right to appreciation is generally exchanged for a lower dividend rate. Investors that purchase stock become owners of the company. Common stockholders do not participate in the day-to-day operations of the business. Instead, they elect the board of directors and vote on important issues of the company. The board of directors makes major decisions, hires the management of the company. Common shareholders receive dividends only if they are declared by the board of directors after dividends are declared for preferred shareholders. Common shareholders generally have the right to attend all stockholder meetings and vote on the board of directors. They share in common stock dividends if they're declared, and they also share in the net proceeds of any liquidation. They can sell their investment in shares at any time to another investor. There are times, and this is not always the case, that they have a preemptive right that guarantees them the right to maintain a share of ownership. Take a moment to read the owner's equity section of the balance sheet. Notice that J.C. Penney calls retained earnings reinvested earnings. Also notice that J.C. Penney does not own their own common stock and therefore does not report treasury stock. Cash associated with stockholders' equity transactions are reported in the financing activities section of the cash flow statement. Take a moment to notice the line items related to stockholders' equity. The line items are dividends paid, stock repurchased, and proceeds from issuing stock warrants. Stock warrants is another type of equity. After viewing this video, you should be able to state the 5 different accounts reported in stockholders' equity. You should also be able to define the 5 different accounts reported in stockholders' equity. You should also be able to identify stockholders' equity accounts reported on the financial statements. We will continue our discussion of accounting for stockholders' equity in the next video. Please fill in the blanks on the stockholders' equity pages in your course pack. Thank you for taking the time to be prepared for class. It is very much appreciated.